Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Brandywine Realty Trust Annual Report. Brandywine Realty Trust offers a wide range of services as a full-service, integrated real estate company. At its core, the company provides property ownership, development, leasing, and management services to various clients. With a portfolio comprising 120 properties and over 20 million square feet, Brandywine Realty Trust is a significant player in the U.S. real estate market. The company's expertise spans across urban, town center, and transit-oriented developments, indicating its focus on creating vibrant and connected communities. This suggests that Brandywine Realty Trust provides services related to property acquisition, development, construction, leasing, and management of commercial and residential properties. Additionally, the company's emphasis on fostering relationships with clients, partners, and local communities implies a strong commitment to customer service and community engagement. Overall, Brandywine Realty Trust offers a comprehensive suite of real estate services that cater to various needs of its clients, including property ownership, development, leasing, management, and community building. The stock price of Brandywine Realty Trust, BDN, has experienced a substantial drop of over 25% in the past year, with a loss of over 56% by year-end. Several key news events and broader market conditions have contributed to this decline. One of the primary causes was the company's Q4 2024 earnings miss, which resulted in a 6.9% drop in after-hours trading. This set a negative tone for the year ahead. Additionally, Brandywine reported a challenging CONE 2025, describing it as a transitional earnings year amidst a macroeconomic environment characterized by tariff uncertainty and high interest rates. The company also faced significant impairment charges in Q4 2025, driven by non-cash charges related to its Austin properties. This led to a wider loss per share guidance range, signaling a more negative outlook. Furthermore, Brandywine announced a reduction in its quarterly dividend from $0.15 to $0.08 per share, which negatively impacted investor sentiment. The broader office real estate market also presented headwinds for Brandywine Realty Trust, with evolving office space demand, macroeconomic uncertainty, high interest rates, and a challenging leasing environment contributing to sector-wide pressures. While the company's Q4 2025 earnings beat analyst expectations, leading to a temporary stock surge, the cumulative impact of these negative events was the primary driver of the significant stock price decline. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, an increase in occupancy rates from 87.8% to 88.3% has contributed significantly to revenue growth. Additionally, rising rental rates have also played a crucial role in boosting revenues. The opportunistic acquisition of high-quality properties in growing markets and effective leasing strategies designed to capture rental growth have further maximized cash flow. However, there are also several factors that have led to revenue decline. Negative lease absorption within office markets due to macroeconomic conditions such as inflation and high interest rates has had a significant impact on revenues. Changes in work patterns, including remote working arrangements, have also contributed to the decline. Furthermore, downward pressures on asset valuations and decreases in rents from the total portfolio have also affected revenue. It is worth noting that other factors such as impairment charges, increases in operating expenses, and interest expense have also had an impact on revenue. These factors highlight the importance of careful financial management and strategic decision-making to mitigate potential risks and maximize revenue growth. The net income of the company experienced a decline in 2025 compared to 2024. The decrease was $4.1 million, with the net income dropping slightly from $197,670 to $180,015. This change can be attributed to various factors, including impairment charges and increased property operating expenses. Profit margins also saw a decline in 2025 due to impairment charges of $67.5 million compared to $53.1 million in 2024. The profit margin decreased from 88.9% to 87.8%. Furthermore, the same-store property portfolio operating margins dropped to 63.3% from 63.9%, primarily due to increased property operating expenses. The reasons behind these changes are multifaceted. Impairment charges, tenant credit risk, and potential economic downturns all contributed to the decline in net income and profit margins. Additionally, compliance with REIT distribution requirements and taxes may hinder the company's ability to maximize profits. The potential tax liabilities from Section 1031 exchange challenges also pose a threat to the company's financial performance. The company's financial performance indicates a concerning trend. A review of the operating cash flow reveals that the company is currently experiencing a significant deficit. Specifically, in 2025, the company reported an operating cash flow of minus $64,424,000. This negative figure signifies that the company is generating more expenses than revenue, resulting in a net outflow of cash from its operations. This trend raises concerns about the company's ability to sustain its business model and meet its financial obligations. The generation of negative operating cash flow can be a sign of underlying issues such as inefficient operations, high costs, or poor management decisions. To rectify this situation, the company may need to reassess its strategies and implement cost-cutting measures or explore new revenue streams. In conclusion, the company's current operating cash flow performance is not generating positive results. The significant deficit in 2025 highlights the need for the company to address these financial challenges and work towards achieving a more stable and profitable position. The company's debt level and interest expenses have undergone significant fluctuations over the past year. While there are discrepancies in the data, a general trend can be observed. In 2025, the total debt increased by $200 million from $2,500 million to $2,700 million, with net interest expenses rising by $12 million from $123 million to $135 million. However, other instances show a decrease in debt level and interest expenses. For example, on page 70, it is mentioned that the debt level decreased by $169 million from December 31, 2024 to December 31, 2025, with interest expenses also decreasing by $825,000. This inconsistency suggests that the company's financial situation is complex and subject to various factors. Despite these fluctuations, one thing is clear: the company's debt level and interest expenses have changed significantly over the past year. While some instances show an increase in debt and interest expenses, others indicate a decrease. This variability highlights the need for careful analysis of the company's financial data to understand its true financial situation. The management of this company appears to be focused on growth and expansion through diversification and strategic acquisitions. The company has a diversified portfolio of real estate investments across various locations, indicating a willingness to adapt to changing market conditions. However, there are also signs that the company is managing its assets to optimize their value, as evidenced by significant depreciation and accumulated depreciation. The company's financial performance suggests that it has been experiencing significant revenue and profitability from its real estate investments. Nevertheless, there are areas where the company's outlook and strategy are unclear, including impairment charges on certain properties and losses from unconsolidated real estate ventures. Additionally, the company's significant debt obligations may indicate a need to manage debt levels and optimize capital structure. Overall, while the company's management appears to be proactive in managing its assets and investments, there are still areas where more information is needed to fully understand the company's goals and objectives. The company has made several significant acquisitions and divestitures in recent years. In terms of acquisitions, the company purchased 2 office properties in Austin, Texas for a total of $72.7 million, as well as 23.2 acres of land in Richmond, Virginia for $4.6 million. Additionally, the company acquired TRC in September 2004, which included 2 Logan Square in Philadelphia, Pennsylvania. The acquisition also involved obtaining a $79.8 million first mortgage on the property from a third-party lender. In terms of divestitures, the company has disposed of various real estate assets over the past 2 years. In the year ended December 31, 2025, the company reported disposing of real estate worth $9,396. The previous year, in 2024, the company reported disposing of real estate worth $2,000 $297. These divestitures indicate that the company is actively managing its portfolio and adjusting to changing market conditions. The company has a history of rewarding its investors through various means. One way it has done this is by paying out dividends, which are essentially quarterly distributions made to shareholders in the form of cash per Class A unit. This practice demonstrates the company's commitment to sharing its profits with its stakeholders. In addition to paying dividends, the company has also implemented a share repurchase program, allowing it to buy back shares from the market. This move not only boosts shareholder value, but also reduces the number of outstanding shares, thereby increasing earnings per share and potentially leading to higher stock prices. There are currently no significant concerns regarding inventory buildup. However, there is a mention of potential risks associated with property acquisitions that may lead to supply chain disruptions in the construction industry. Additionally, tenant installation costs and concessions could also be related to supply chain disruptions. Despite these mentions, specific concerns about inventory buildup or supply chain disruption are not explicitly stated. That concludes the financial summary for Brandywine Realty Trust. Feel free to comment below, and I will be happy to answer them when possible.